Good afternoon, morning. It still is. My name is Grant Deviney with Delta ERC, and I have the pleasure of introducing our next speaker here today. Tell you just real quick a little bit about us. Delta ERC is the ERC stands for Employee Retention Credit. A lot of you have heard of it. You've been blasted by emails, phone calls. I'm not one of those. I'm not an email. I'm not a phone call. I'm real. I'm here. Have partnered in the lumber industry. Really feel passionate about it. As a matter of fact, pretty well dedicated our agency to this industry for the remainder of the program. So there's a lot of misinformation out there. But employee retention credit, if you have some questions about it, please take a few minutes. In your bag, you may have gotten one of these. I know a lot of those bags, the stuff finds the trash can pretty quick. But I'm be around. Find me, talk to me. Each of you have a little wooden something that my partner handed out. Does anybody know what that is? By chance? Small room, we can yell. It's around to it. Yeah, see, somebody did. Yep, that's. I'm a good old Southern boy. One of our statements was, "We'll do it when we get around to it." So if you've been waiting to get around to it to look at the ERC, now everybody's got one. If you've done it or can't do it, or know somebody that needs it, give it out, hand it out. But back to what I'm here to do is I had the pleasure of meeting Eric this morning and chatting with him and talking to him a little bit. He works to sort of take what funds we get you, significant funds, and help you better plan with them. Keep your house in order. And you've all got the bio there in your book, but I think probably one of the most notable things that we were talking about is Army Ranger, former service. He's a veteran, and his pedigree is phenomenal. But really good guy. So with that, let me turn it over to Eric to chat with you about some investment.
All right. Can everybody hear me okay? We won't be too long. None of this will be super new to anybody. And I know everybody's probably hungry too. So I'm with Creative Planning. So we are a registered investment advisor firm out of Overland Park, Kansas. We manage approximately $250 billion across all 50 states for both individuals and then institutions. So I'm on the institutional side, and what our team does, we work with nonprofits, organizations like NHLA to basically manage the assets of nonprofits. And then the main focus of our firm is the assets of folks just like you. So we're just going to walk through some slides on sort of how we view the markets, just some things to think about when you're looking at selecting a financial advisor or working with the one you have now. So everything we want to do, really want to understand your current situation. So obviously you want to start with where we at, right? So with all of our clients, when we take this holistic approach, we're going to start with the net worth statement. Probably everybody in this room does one, but I just want to reinforce how important that is, because if you don't really know where you're at, it's really hard to tell where you're going. This is sort of what some of the output looks like. So when you work with either us or the financial planner of your choice, financial planning firm, make sure you're seeing something like this. This is just a hypothetical of a John and Jane. You can see there, they're different revenue streams, Social Security, other income, and those factors. And so what you can do is you can go ahead and run this projection all the way out till you can choose a time of death. We're just going to assume here that everybody lives till 99. So that we've all already got better today. So this is a really big component when you look at how you're putting together your financial plan and your portfolio. Cash is not king. No, nobody likes to hear that. We all like to sit on cash. We are all scared to invest at all times. That's understandable. If you're like me, you've probably already read 17 headlines this morning, and you're pretty convinced the entire market will come crashing down by the time we get out of this meeting. So when I talk about cash is not king, what we're really talking about is any cash outside of what you might have in your bank account for short-term needs, you really want to get that into the markets. This is a pretty overwhelming chart if you look at the hole in that pocket that cash will burn, especially if adjusted for inflation. This chart ends at 2021. The 2022 inflation numbers would look about the same. We think back to June of 2022, inflation was about 9%. As of this morning, it's just under 4%. So it has come down. This is a really good illustration of do not sit on cash thinking you're going to be able to figure out exactly when to get it in the market. Very difficult to do. So when you walk through a financial plan with your advisor, you're going to get all of the cash that you do not need, and you want to go ahead and get it into the market. We'll talk about why it's basically impossible to time the market here in a minute. This is a really good illustration of how the markets change. I was not alive in 1960 or 1970. Was born in 1980. But if you look at this, it's amazing how the investment landscape changes. So when you view the investment landscape, it's very difficult to pick one company over the other. It's very difficult to decide, well, which is better? Is it Amazon? Is it Google? Is it Costco? Is it Walmart? So again, when you're getting with your financial planner, viewing this financial landscape is very important. Obviously, this is the S&P 500, so the 500 biggest companies. I'm sure back in 1960, everyone was saying General Motors will constantly be one of the biggest companies. It's still pretty big, but it's not in the top 5 anymore. So in 2020, you can look at some of those names, and I'm sure we could all sit here and say there's no way some of those names are going to go away, but I don't know. It can be tough to tell. So here's why we think it's impossible to sort of beat the markets and time the markets and actively get in and out. 75% of mutual funds out there that try to beat the market do not. It's even worse in the long run. In the long run, it's about 86%. So over a 5-year time period, 75% of those trying to actively time and beat the market simply cannot do it. So when you're selecting an investment advisor, you're going to want to look for somebody who's a little bit more passive. So this just means we understand what the market's going to do. The market's going to go up and it's going to go down. We are not going to try to time it. Very hard to do. We'll talk about why these markets move. This is a very interesting topic, especially these days. So when you view the investment landscape, you do not want to invest just in the US. Obviously, everyone has a bit of a home bias, including us. But this is very interesting. If you look at this 10-year period, you've probably often heard this referred to as the lost decade. So this is from approximately 2010. You can see way over there on the left, large cap US stocks essentially returned zero. So the S&P essentially returned zero. Mid cap stocks and small cap stocks had a decent return. But if you look at international and emerging markets, they had pretty good returns. Again, it's never enjoyable to think about investing in international at EM, especially right now with rates high and a strong dollar. But you certainly need to have a diversified portfolio that includes both international and US equities. Our portfolios generally we have about 40% of the equities in international. We shift that kind of dependent on any of our client needs, but just a really good look at why it makes sense to invest globally. This puts what I just said more graphical. So this looks at the top blue lines, or anytime the US is outperformed international, and the bottom blue lines, or anytime that the international is outperformed. So like I said, even though you want to own international, it can run away and hide. It has been currently running away and hiding for going on 12 years right now. So right now, a lot of our clients that own international and EM, they don't love it. We know we want to own it, but these are the times where you sort of have to stay disciplined and not say, you know what, I've had enough of that. So this is really good representation of how it's very hard to know the ebbs and flows of which is going to outperform and which is going to underperform, but a good indicator of why you're going to want to own an internationally based portfolio. So when we talk about timing the market, I'm going to move a little bit. See that? So when we talk about timing the market, so this is the S&P, this is a great chart on why it is impossible to time the market. The best 30 days since 1992, so the best single day in the S&P, has all taken place in some of the worst financial crises we've ever seen. So think back to October 2008, the financial crisis. October 13th, 2008, the S&P was up 11%. And it's just remarkable that all 30 of the single best days in the history of the S&P have been right when none of us feel very good about being in the markets. This chart here, the blue graphs appear to be missing, but this puts in the math into the last slide I showed you. So this goes back to 1990. So not all the way back. But the chart on the left, the total period, if you're in the S&P every day since 1990, you've had an annualized return of almost 10%, about 9.75. If you go 2 bars to the right, if you missed only 5 days, so the 5 best days out of since 1990, your return goes from 9.75 all the way down to 8.23%. That's only 5 days. If you go further down to the right, if you were very rattled by the market or your financial advisor was very rattled by the market and tried to time it, and you missed the 25 best single days in the S&P, your return went from 9.75% down to under 5. This is a pretty remarkable slide because even those of us who've been in this industry a long time who think we know how to time the market, it's just not going to work. You're going to be in a pretty tough spot. The bear markets don't have to be devastating. I was talking to my mom the other day. She likes to read a lot of the news, which is not a good idea. She knows I'm in this industry, and she said, Eric, this is as bad as I've ever seen it. My mom was born in 1952. She's been through quite a lot in life and in the markets, and here we are. And we had a funny conversation of, Mom, what makes everything so bad right now? We had some decent answers. But if you just look at some of these charts and understand what the markets have been through and the headlines that the markets continue to fight against, it's pretty remarkable. So if you look down there at the bottom, a drawdown of 10 to 20% has happened 15 times. And the average time to recover has only been 8 months. Let's think about the totality of your life and the totality of how long you need your investments to be invested and grow. You don't want to be out of the market. These bear markets simply do not last very long. 20% or more drops, so your typical, what we would call a bear market in this industry, happens about every 5 years. No one can sit here and tell you what they think is going to make the next bear market happen. And it takes about 27 months to recover. Again, a slightly longer recovery. But so far, every single bear market, 100% of the time, has recovered. It hasn't failed yet, that the market eventually recovers, moves to all-time highs. And when my mom calls me and says, Eric, this is it. This is the big one. I say, Mom, what's the big one? Well, the markets are going to go down. Yes, they do. And they recover very quickly. So if you put all that together, that top left circle, 74% of the time, the market's positive. That's 90 years of positive market growth. Only 32% of the time, we've had negative years. And again, this is the S&P. It's not the entire investment landscape, but by market cap, the biggest. That averages to an 11.7% average annual return just by being in the market. That's by putting your money in the market and not doing anything. I want to make that very clear. This is not dinking and dunk day trading. This is by getting invested, having a good plan, and sticking to that plan. So as you can see here, there is a lot of drama in those short periods of time. This is just another look at these are bear markets and bull markets. Again, this is a little bit anecdotal, but if you just sort of ran your eyes down that scale, obviously we spend a significantly more time in bull markets than we do bear markets, but everybody cares about the bear markets. I'm always as long as I've done this, I'm very fascinated. Everyone gets very upset, understandably, about the bear markets, and we all ignore the bull markets that these markets continually hand out. This is behavioral. This is okay. We're humans. But this is also something to think about when you're designing your portfolio and meeting with your financial advisor. This is another view of that. This is a really good view because you might be able to look back there to 1926. And every one of those years, you might be able to think of some catastrophically awful event that happened either in this country or globally. We have the Great Depression on there. We have the invasion of Iraq in there. We have the Great Financial Crisis on there. What's interesting is COVID is way over there on the right. We're still sort of coming out of it, but it's very interesting. So again, graphically, if you think time, the history of market ups and downs are significantly up. They're up significantly more than they are down. So market timing. This is a really good slide. A lot of financial advisors will call you and say, this is it. The world's going to hell. We need to move the cash. We need to get out of the markets. And this is a great slide on why this doesn't work. So that far left graph This happened to be the bottom of the tech wreck. So the 2001, 2000 to 2002 time. Obviously, nobody knew that October 10th, 2002 was the exact bottom. But who tells you they knew that the bottom probably is lying. But what's interesting is if you look at 1 year later after the bottom of the tech wreck, the S&P was up 36%. Again, this is from doing nothing. This is from being in the S&P, and this is from staying disciplined. This doesn't even include, as markets pull back, you want to be a buyer. So this is just staying disciplined. March 9th, 2009 just happened to be the bottom of the great financial crisis. Again, nobody knew that. 1 year later, the S&P was up 72%. I do know where I was at March 9th, 2009, and there's no way I thought 1 year later the markets would be up 72. And in fact, if somebody told me they were going to be up that much, I would have probably told them they're crazy. Fast forward more recently to COVID, March 24th, 2020 just happened to be the bottom of the markets during COVID. Again, remarkably, 1 year later, the markets were up 77%. I won't ask for a show of hands, but in March of 2020, did anybody feel good about the S&P 500 or the markets? No, it was very uncomfortable. Unfortunately, we know in our industry, at each one of those three big moments in the markets, a lot of investors made a big mistake. They decided, right as the markets got bad, they raised their hands and they said, that's it. I can't take any more. It's understandable. Usually when it gets pretty bad is the time that everybody wants to get out. This is why it's incredibly important to have a disciplined plan with a really good advisor who's going to say, no, this is exactly when we don't want to get out. In fact, you can't get hurt. And this is very important to understand. You cannot get hurt in these markets unless you sold, right? You're guaranteed to get hurt if you sell when these markets get bad. You can hang on. And if you can be a buyer, incredibly uncomfortable. The math is overwhelmingly on your side that you come out ahead. And not just the math, but you want to be able to participate with these markets. I want to say it again, 100% of the time, every bear and bull market, or every bear market we've seen recovers to a new all-time high. It hasn't failed yet. So those were three specific instances. Now we want to go all the way back to 1926. So exactly what does happen after markets pull back? We'll look at that center triad there. So that's the return after a 20% market decline. So that's your typical definition of a bear market. Your cumulative return going all the way back to 1926 after a market pulls back 20% is 72%. So again, these are overwhelming odds in your favor of these markets recovering. Even greater, after a 30% market decline, which doesn't actually happen all that often, your cumulative 5-year return after a 30% decline is 50%. So this is all the way back to 1926. This is an overwhelming amount of data. Again, nobody knows where the bottom is going to be. But when you see these markets pulling back, these are the opportunities. And these are the times where you need a very strong plan. You need a very strong financial advisor to get you to stop reading the headline, as I told my mother. And this is a really, really good slide. So this is the intra-year and calendar year returns of the Russell 3000. So the Russell 3000 is essentially the entire U.S. stock market, so large cap, mid cap, small cap. The top blue ticks is the intra-year high that year. The bottom red tick is the intra-year low. And then the blue bar is where the market actually finished. So two things will jump right out at you. Since 1979, the entire US market has only finished down 8 times. So there's 43 data sets. The market's only finished down 8 times. My math is right. That's somewhere around 80 to 82% of the time. Since 1979, the US market has finished up. But here's what's interesting. Again, this is empirical. And just bear with me here. If you see that down 10% number, and just sort of scan your eyes to the right. Maybe half the time, the market's been down 10% during the year, but still finished up. If you drop down to that 20% line, the market's been down 20% intra-year, call it 6 or 7 times. I haven't counted, but if I look from here, 6 or 7 times. So this is why it is incredibly important to stay disciplined. And again, nobody can tell you where the market's going to finish, but when you see pullbacks, that is when you need to be getting excited. This is when you want to be rebalancing. And if you can, this is when you want to be adding dollars to the market. And you're never going to get it right. You're either going to be early on the bottom or you're going to be a little bit late, but that's okay. This is an overwhelming slide when you think about why try to time the market. Because don't forget, from 1979 to 2022, we saw a minute ago, these markets are returning about 8 to 11% a year by doing nothing, by just participating. Okay, so even though the market doesn't go down very often, what can you do when it does go down? So there's something called tax loss harvesting. I'm sure many of you are familiar with this. But if you have a retirement account, so maybe you have a Roth, maybe you have a traditional IRA and some others, but if you have a taxable account, a lot of clients have a lot of their assets in taxable accounts, you can do something called tax loss harvesting. So in this scenario over there on property one, that could be property, but let's call it stock or whatever you want to call it, your portfolio. Let's say you purchase an asset for $100,000 and the property goes down to $70,000. So it's down 30% and you're down $30,000. What you can do is you can actually sell that property and realize that $30,000 loss for your tax returns. And at the same time, you can buy another stock, or we can call it a property, for that same $70,000. So then as the new property recovers, let's say it shoots up to 120, as the markets always do, now you have a $30,000 loss on your tax return, but you actually have a gain in the portfolio. Whatever advisor you're working for, you need to make sure they have a tax loss harvesting strategy. So for example, at our firm, if we own an S&P 500 ETF and it's down, it's rarely down, but if it's down, we're going to sell that in your account. We're going to take that loss and we're going to move it right into another S&P 500 ETF. And now you have a loss on your tax return that you can offset future gains. So this is incredibly important when you think about holistic wealth management, because this is also tax planning. So if you're working with an advisor, like Creative Planning, we do taxes in-house. We do wills, trust, and estate work in-house. So if you're a client at Creative Planning, you have a tax advisor. And so through the year, what they're doing is they're working with your wealth manager and your financial planner to understand your specific situation. And tax loss harvesting is a crucial element of that. So we're going to put it all together. And then if we have a few minutes here, I'm more than happy to stick around for questions as well. So know your personal situation. I can't talk about that enough at Creative Planning and a lot of other firms. We don't use models. We don't stick everybody into the same thing. Your unique situation is unique to you. Your wills, your trusts, your tax situation, your estate situation, and your financial advisor needs to understand that. Know which asset classes are best for you. Obviously, the asset classes out there are stocks, bonds, CDs, money markets, alternatives. You want to buy the most effective way possible, meaning you want low-cost investment vehicles. You want to trade at the right times for the right reasons. Again, tax loss harvesting. The bottom one is a really good one. Don't mess it up with behavioral mistakes. This is really, really hard to do. If you think you're about to mess it up, call your advisor. Please call your advisor. Don't call your brother-in-law. Re-examine on a periodic basis. So with all of our clients, we meet at least twice a year, because perhaps if the situation is uniquely changed with you and your household, that's something your financial advisor needs to know. Focus on the long-term trends. We've covered that quite a bit. And most importantly, enjoy your wealth. There's a lot of good data out there on the internet right now on how to grow your wealth. Enjoy it while you're doing it. Take a vacation, buy the $13 latte, right? Enjoy it while you're doing it. So, and then these are some really crucial aspects, and this is just how creative planning views the world of choosing the right financial advisor. So as a RIA, or registered investment advisor, creative planning, much like other advisors out there, we only get paid on the advice we give. We do not get paid on commissions, trailing fees, and we don't get paid for recommending mutual funds or ETFs. This is incredibly crucial when picking your financial advisor. If you're on the left side of this screen, your advisor is going to be sitting on the same side of the table as you are. If your advisor is on the right side of that screen, they're going to be sitting across the table. It doesn't mean they don't do good work, but they are going to be a little bit biased. So for example, if you were to work with a creative planning advisor and we go to build out a portfolio for you, we aren't encumbered or biased by anything. We go find the best vehicles at the lowest cost for your investment. And with our size and leverage, we have a lot of the fund companies working with us to keep expense ratios and costs down. This is very important. And lastly, this is a really good reminder. This was a study we found recently, and it looked at investors who look at their statements monthly versus investors who look at their statements annually. We could probably even drill this down, people who look at them daily. Again, I won't ask for a show of hands, but it's tough not to be checking our retirement accounts on a daily basis. But what we found was, or what the study found, I should say, is that investors or clients who looked at their statements monthly had an allocation of 60% bonds and 40% stocks, but those who looked annually had an allocation of 30% bonds and 70% bonds. And the difference there is that the monthly investor gets much more nervous and gets much more conservative. Now, perhaps in your situation, a portfolio of 60% bonds is appropriate. That's the reality. But most likely, the investors who look monthly get very nervous and want to get more and more conservative because they see more and more headlines they don't like, versus the client or investor who looks annually understands stocks outperform bonds in the long run, and it's not even close, by the way, not even close. So again, you want to have the right amount of stocks and bonds. Perhaps it's 30%, perhaps it's more, but the less you check it, the better off you're going to be. Because you can probably be a little bit more aggressive than you realize if you actually sit down and do a comprehensive financial. And that's it. I know everyone's hungry. I'm going to hang out right over here for a few minutes if anybody has any comments or questions. Thank you.